The housing market continues to overheat and prices keep rising. I'm actually getting kind of bored of this market right now. Things have to change. It's just being choked and stalled. It's like Groundhog Day. Every month, over and over again, the same thing over. Prices are rising, blah, 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 yada, yada, yada. I'm sure you're tired of it too. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate because we do need a shot of that from time to time. Hope you're doing well. Today is the 23rd of February. And what does that mean? It means it's the last Tuesday of the month. And when the last Tuesday of the month happens, we have the release of the Case-Shiller U.S. house price and index data. We'll talk about that in 1 second. That's pretty much all I'm talking about today. But first of all, if you're not already a subscriber, if you could do me a great favor and smash that subscribe button, help my channel grow, I would really appreciate that. And thank you very much. Now, this video is brought to you by Foreclosure.com, our friends at Foreclosure.com. If you want some information, go to gethousingdata.com. Check out what they've got. Pretty much everything that I do and talk about is distressed properties, and you can find that here. Go to gethousingdata.com. I'm partnering with Foreclosure.com, and they're the nation's premier provider of distressed property listings across the U.S. So please check it out. Why do you want to check it out? Because they got a 7-day free trial. Under $40 per month, go to gethousingdata.com. It's a very inexpensive way to take a look at what's going on in your local housing market. All right, so the big information or the big release today is the fact that Case-Shiller, did their monthly deal and realized that Case-Shiller is what I call a tag-along, drag-along calculation. So we're talking about December prices, not January's or February's, talking December prices. So basically what it comes down to is that U.S. home price accelerates at the fastest pace since 2014. Which is no surprise. So we can see that the numbers are jumping. Phoenix, San Diego posted, and Seattle posted the biggest gains. That is a price, or I guess you say the price rise is 5 times the Fed's mandated level of inflation, which we'll talk about this in the next little while. So clearly, historically low mortgage rates have fueled pandemic housing rally with scant inventory of homes to buy, helping to boost prices. So we all know this is not a normal market, everybody, right? There's the graph they show. So basically I guess you could say the amount of annual year-over-year pricing gets us back to 2014 levels on the increase side. That's off that graph. Historically low mortgage rates have fueled a pandemic housing rally with scant inventory of homes to help to buy, boosting prices. The commentary really is, will the Fed never learn? This pump-a-thon didn't end well before, and with exponentially more debt and leverage now, it will end in even more wealth transfer and socialism for the rich. And this time, the pitchforks have already been sharpened. We also note that the moratoriums on evictions and foreclosures are also distorting the market. There's no question these policies are needed to keep people from being displaced in the midst of a pandemic, but they will eventually have to be lifted, and it's not clear what will happen when they do. Well, I certainly know what will happen. There'll be a little more chaos out there. So this really is the home price index to income index graph, and you can see that the home price index has far outpaced the more on an exponential level the growth of the income index, which has been fairly linear. So you can see where I'm pointing with that red arrow, that kind of where it dips. So really, when home price index dipped below the income index, that's the best time to buy. Funny enough, that was around the 2012 mark where the trough was in the previous housing crash crisis. We'll talk about it in a sec, but that really was the best time. So if you bought a property over that time period, you're sitting pretty with a ton of equity and you've done a good job. Maybe it was timing, maybe you were smart, who knows? But either way, you've done well for yourself if you purchase and still have that property from back then. All right. Home prices soar at 5 times the Fed's inflation target in all U.S. cities. So same deal. Basically, what we're looking at here is just another article under the same sort of guidance. The fact of the matter is, all the cities that are under the Case-Shiller showed not only that home prices have surged at the fastest pace in 7 years, but rising at a double-digit pace for the first time since 2014. The annual price increase for every major U.S. MSA. So every major USA had a price increase, meaning that the average home price across all of the U.S. is now rising at over five times the Fed's stated inflation target, and even the cheapest U.S. MSA is rising at nearly four times the Fed's inflation goal. So ultimately, this is where some commentary has been going on the past month about the Fed misjudging the housing market, misjudging what's going on in the economy, and whatever policies they're implementing really are not helping. It's actually fueling this increase, which is making it actually more difficult for people to be homeowners and more expensive for everybody, overall. So you can see that, you've got the green being November 20 and the blue being December 20. So basically, the 1 year price change percentage by metro area for November and December. So really, I'm looking at this chart. So, November had good price increases, but December's year-over-year price increase beat the value of November's price increase. So really, it just keeps going farther and farther north. That's a lot of stuff happening, and a lot of increases. People can't keep pace. Ultimately, their commentary is, which is interesting. Consumer price index does not show house price inflation because it uses a non-market rent index to capture the trends in housing inflation. The Bureau of Labor Statistics, BLS, estimates that the non-market rent index has increased 2.5% in the past 12 months, or 450 basis points. Their commentary here is, if actual house prices were used in place of rents, core CPI would have registered a 3% gain the past year, nearly twice the reported gain of 1.6%. So really what they're saying is that they're using the wrong, I guess you could say, index to calculate what's happening, and that basically is kind of messing up what is really being discussed with respect to housing prices. So that's really kind of interesting here. And the next economic cycle will be filled with unique tipping points, and no one should assume that policymakers can control or offset them. So if we actually look at the graph here, you can see that, and again, I just highlighted that commentary. The Consumer Price Index does not show housing price inflation because it uses a non-market rent index to capture the trends in housing inflation. So, the government, the Fed, is using the wrong analysis here, the wrong index, and, therefore it's downplaying what's happening in the housing market. Yeah, they expect some correction. We'll see what happens. It shouldn't, when people get back to work or things sort of, ease off the pandemic, things should slow down. Well, we don't know. And how can they predict or discuss it if they're using the wrong index here to make their calculations? So just keeping that in mind. And basically, you can see that Case-Shiller house prices have spiked and continue to spike at the blue line's Case-Shiller at a kind of, that's a bubble exponential type level, whereas the CPI, Consumer Price Index owner's rent index is actually plateauing or actually dropped a little bit over the course of 2020 and now into 2021. So the two are divergent, and that means that that's, I guess, whatever. I guess they're happy with it at the Fed, but from what real economists and people are saying, that this does not make sense, and this is with a misguided misjudging of what's happening in the marketplace. So there you go. So let's go to the formal, I guess you could say, CoreLogic release that came out this morning. So the S&P Dow Jones indices today released the latest results for the S&P CoreLogic Case-Shiller indices, the leading measure of U.S. home prices. Data released today was for December 2020, show that home prices continue to increase across the U.S. by more than 27 years of history that are available for the data series. So it just keeps going up and going up. Note the transactions for October 2020 and November 2020 for Wayne County, Michigan are not available due to delays at the local recording office caused by the COVID-19 pandemic. Now, for whatever reason, since the pandemic started, Wayne County really has not produced any housing information specific that CoreLogic would pick up on. So we really don't know what's happening in Wayne County, which is where Detroit is. I don't know. Listen, other locations across the country seem to be able to produce the information. Don't know what's going on there. And I'm now, when certain things happen over and over again, that's when I kind of go, something suspect is going on there. I don't know. But anyway, maybe it's the one location is not doing well and they don't want to show it to us. So ultimately, in the end, all the 10 city composite, the 20 city composites up, the nationals up. Phoenix, Seattle, and San Diego continue to report the highest year-over-year gains among the 19 cities, excluding Detroit. In December, Phoenix led the way with 14.4% year-over-year price increase, followed by Seattle with 13.6% increase, and San Diego with 13.0% increase. 18 of the 19 cities reported higher price increases in the year ending December 2020 versus the year ending November 2020. So there you go. So basically everybody is moving on up. Home prices finished 2020 with double-digit gains. As we can see, the National Composite Index rose by 10.4% compared to a year ago levels. As COVID-related restrictions began to grip the economy in early 2020, their effect on housing prices was unclear. Price growth decelerated in May and June, then began a steady climb upward. In December, reports continues the acceleration in an emphatic manner. All right. These data are consistent with the view that COVID has encouraged potential buyers to move from urban apartments to suburban homes. This may indicate a secular shift in housing demand or may simply represent an acceleration of moves that would have taken place over the next several years anyway. Future data will be required to address that question. So basically, that's the commentary. So if we go to, some of the way some of the graphs look and everything, you can see where, I guess you could say where we took a hit. Obviously, the big dip that you see there is 2006. If you go to the 2019-20 part of the graph, the far right, you can see the dip is when the pandemic came in. So we actually had deceleration of values. And then, of course, which really was a stall once things got figured out and people came back into the marketplace. It's almost like the spring-summer selling season was just prolonged by a few months. And now we're seeing everything increasing. The run on inventory is out of control. And basically, that's like an exponential line. So for me, this is, listen, we've talked about bubbles. I don't think anybody can disagree that we're not in a bubble. We are in a bubble. We have an affordability crisis. The disagreement, or I guess the unknown factor, is how it's going to manifest and what's going to happen and whether this is going to maintain, deflate, or burst. That's the whole point. Typically, bubbles do not burst. Do not deflate. They typically burst. And there's issues, so we'll see how long this can be propped up. But really, this is like the end run. Like the last little bit of a bubble is almost like you're slapping you in the face. I'm going to run this as hard as I can till it peaks, and then I don't care what happens after it bursts. So anybody, take advantage of it now. I think, as I mentioned earlier in different videos, that we're seeing shifting. We're seeing shifting and relocation. We're seeing different mindsets now on where people want to live. So certain metro locations will see some decreases in values, and others will see some increases going longer. So it's not a national situation. I think it's a metro-based, or I call the metro bubble issue, which will sort of manifest or play out over the year. Various locations will see more distress than others, and that's going to be a factor in how it's going to play out as well. And the factor will be how it's controlled will be how it plays out. So if we take a look at this, this is the general index from 1987 to where we are today. You've got three lines. The thick dark line is the national index, the thinner line is the 10-city composite, and the dashed line is the 20-city composite. You can basically see how everything has pretty much gone up for the peak in 2006 and 7, down to the trough in 2012, and we've been slowly sort of making our way up year over year. So here we are in 2021, where we are significantly higher than the 2006 peak. Just how high are we? Well, let's take a look here. This next graph shows the fact that the national level, go to the right-hand part of the chart, we are 27% above the 2006 peak, which was July of 2006. That was the highest level in national. You can take a look at the 20 cities, only 16.6% above the peak, and the 10 cities only 12.3%. But it just sort of shows you in context where we've grown from that point in time. So national is up big time. If we actually take a look, the trough of 2012 was down 27% national, and now we're actually up 27% from the peak, which is kind of unique. But you take a look at current from the trough of 2012, it's almost 75%. That's huge. So basically, you've seen we peaked, we cratered, and now we're more than peaking. We're 27% higher than the previous peak. So please keep that in mind. Is it frustrating? Certainly is. Do you want to buy a house now? Sure, you want to buy a house, but life is difficult, and it's one of those things you don't know what to do, and I get it. I mean, I understand it from a retail perspective. Do you buy a house now because you think it's going to keep going up? Are the real estate agents going, you better get one now because if you miss out on it, it's too bad. Should you have bought one last year? Well, I can't tell you what to do for your own personal family situation. I know how I feel personally about it, that this is unsustainable. And I can tell you that a lot more people who are out in the industry right now are talking about this market is completely unsustainable. And we've already seen some interest rates rise over the past couple of weeks. They've risen the most in the shortest period of time. So even though we still have record low interest rates and lots going on, there's been a small rise that really is not that noticeable. But when you start extrapolating the information out, there actually was a rise in rates, and that's probably what the Fed's going to do slowly, sort of quell what's going on here. But if we take a look at each individual metro area, Atlanta up 8.9%, Boston 11.4%, Charlotte 10.2%, Chicago 7.7%, Cleveland at 11.5%, Dallas at 8.4%, Denver 9.2%. Detroit with the dashes across the board there. Why? Because Detroit's not reporting due to COVID, and their clerk's office or recording office apparently is not working. Las Vegas 7.9%, Los Angeles 9.9%, Miami 9.2%, Minneapolis 10.2%, New York at 9.9%, Phoenix the winner 14.4%. I think Phoenix has the I guess you could say the prize for having leading the year over year price increase value charge for I think it's 19 consecutive months or something like that. Portland 9.9%, San Diego 13%, San Fran 8.7%, Seattle 13.6%, Tampa 10.7%, and Washington 10.3%. Those are pretty healthy increases for sure. Lots of double digits and lots approaching double digit. And basically, the lowest we see is Las Vegas at is Cleveland at 7.7. Oh no, sorry. Chicago at 7.7%. That's the lowest year-over-year increases for December, which is pretty substantial if that's the low end. So please realize there's a lot going on there. What to say? We've all heard it over and over again. The fact of the matter, and what I always keep saying is that now more and more people are calling this an unsustainable market, and something has to happen. It just depends on how it's all going to play out. Simple as that, everybody. So that's why I say, when will this ride end? This market cannot be sustained at the current pace. We know that forbearance has been extended, and some of the expirations that was going to happen at the end of March was pushed out. We were looking at 600,000 seriously delinquent people coming out of forbearance at that point in time. Some will still come out of it. Others may elect, or for whatever reason, be able to extend their forbearance another 3 to 6 months. So, they've extended out to the 30th of June from March 31st. Same with the foreclosure and eviction moratorium stuff. So it's stalling the marketplace. It's choking the market. A lot of stuff that should be coming out, as was mentioned, that we're not seeing distress hitting the market. So therefore, less inventory and less lower price inventory to make an impact. As I always say, single-family rentals become a very desired asset class. People are looking to get their hands on this for sure. Simple as that. Looking at the numbers here, Black Knight Financial percent of loans delinquent in foreclosure process as of 2020, 3.429 all in. I do think this number is a bit lower, and I don't think it's an accurate number. Why? Because we get conflicting statistics. The actual number is much larger. Realize that a lot of stuff that's being talked about here is extrapolation and samplings that they're blowing up to say this is where we think things are at. So the numbers by themselves are flawed. I do believe that the 3.429 is a number, but I think we're north of 5 million for sure. 5 million is the number I'd like to use, if not more. And these are people who are not paying their mortgage, are delinquent in their mortgage, or are facing foreclosure, or are currently in forbearance programs. So I'm thinking we've got 5 million plus of these people minimum out there. And that's going to be a lot more than they're planning on, and that's going to create some problems, which hopefully will bring price points down and provide a lot more inventory as time goes on. But I've got my thoughts on how that's going to play out. Obviously a lot of people's short sales on their pre-foreclosure sales are poised to become a more dominant share of the stress market in 2021 and beyond. So this is not news. Everybody's been showing these same slides for the past couple of videos now, past few videos. So the data analysts people are talking about having lots of foreclosures next 4 to 5 years, and thus a lot of short sales and things will be happening as well too. So you got to get involved now. Jump on it. Remember, 1% of all the on-market property sales fall into the distressed property category, which are REOs, bank-owned, and short sales. No one's doing short sales. How do we know this? Because back to the 1%. As I say, the numbers don't lie, and 1%, well, sometimes they do, but in this case, if 1% of all the existing sales, or less than 1% of the existing sales are REO and short sales, that means that the market's not moving, and there's a lot of opportunity there. You might want to reach out to me for that. Foreclosure filings quietly increasing. More properties scheduled for foreclosure auctions. I'm seeing that now. Again, think back to the 1% rule I said. There are opportunities there. But the point, though, is that stop fighting the housing market. So I think, I've sort of always had that dig my heels in. If, everyone's saying the market's great, I'm saying it's not, blah, blah, blah. Well, you know what? I've learned in my old age now is that, I know where it's going to go, and I've got experience in that, and I'm pretty confident. So I don't have to keep convincing you guys out there that what's going to happen. Stop fighting the housing market. Work with what we are given, because if you can get your hands on distressed properties, there's a ton of them out there, and it's growing. But we have these huge retail price increases. Well, guess what? Retail numbers big, distressed property purchases, cost less. So there's a difference there, right? We're going to see a difference in opportunity, which means larger margins, larger spreads if you want to get into that marketplace. So that's where I really think there's some opportunity there. Ride the wave. Select a local market or play on your own. Get control of distressed property. You will earn money. You can sell it retail. You can flip it to a cash flow buyer. You can do a fix and flip, or flip it to someone who will do that, or partner with people on it, okay? If you control a homeowner or seller, have a contract, it's like the Willy Wonka golden ticket, all right? As simple as that. This is what we talk about when people who are in my network and system. So, and then having said that, I do have something new I'm launching. So I have a advanced short sale training program, which I think everybody should be involved in. But if you're not ready for it yet, I've got something new. It's called Zombie Foreclosure Flip. And that basically really is a blend of what was my former Never Pay retail program with really adding the distressed property element to it. Just Zombie Foreclosure Flip sounds a little more pertinent to today's distressed market than Never Pay retail, okay? But the point is that it's like double the program for one. So if you want information on this, I'm working through it right now. I'll get you some great pricing if you want to jump in before the formal launch. There's benefits and bonuses and cheaper pricing right now. So reach out to me. I'll give you information on that. Look at the monthly distressed property for December 2020 in my neck of the woods. I'm going to blow up this slide. I don't know if you guys stick around to see this. So closed sales. This is just single family homes. Does not include condos, mobiles, manufactured, villas, townhomes, or income rental properties, etc. It's just single-family residential homes to make it easier. You can see that we had almost 2,000 closed sales in our county down here. Median sale price almost 300 grand. The foreclosure REO bank-owned, look at their median sales price, about 45 grand less. Look at the short sales, about 75 grand less. Now, granted, very few closed sales in those two segments, but what that means is that no one's doing that part of the business. That's the first clue right here. Secondly, look at the difference in the median sales price. Okay, 45 grand, 75 grand. That's a lot of equity and some good discounts there. And I can tell you on some of these short sales that these are just basic traditional retail short sales. And I can tell that no one's working it like we would to push property values down and position it with the right system and the right desired outcome. So please keep that in mind. That's why you should be doing this. All right, one thing I want to say here is that so we'll talk about me personally now, because I'm an egomaniac, and we'll talk about what my needs are out here. I need financial partners for fix and flip projects in Florida. Why is that? Because I'm getting my hands on more deals, and because there's great opportunity where I live and in the state I live in. You may want to look at this. I can do turnkey real estate investments, or you can literally be a financial partner, because people are buying. There's not enough stuff going on, not enough properties available. And we come across a lot of good off-market things. So I'm looking for really investment partners who would like to make great return on your investment. And you know what? Secured by the property. So you can actually own and hold the property. We'll be doing the work down here, and we'll be sharing the income on the back end. So something you want to look at, give me a call or reach out to me and we'll call. By the way, back to the gethousingdata.com if you want to see what's going on in any local market. 7-day free trial, under $40 per month. Great inexpensive price point to see what's going on. And this is the thing. Everyone complains and laments. There's no deals in my market. What am I going to do? Well, you know what? jump on this. So for 40 bucks for 1 month, you can do some research about what's happening in your local market and get some enlightenment on what's going on. And maybe you'll feel better about what's going to happen in the future, and that might incent you to learn the other part of this business, because I do believe that really retail buying is kind of dead now, guys. The retail industry is dying. You're going to have to take different paths to get better priced homes as time goes on. But anyway, guys, I'll tell you about it. Just connect with me, Randy at luxuryshortsales.com. But thank you for the views, likes, and comments. Please reach out to me. Please share the video with your family and friends. If you're not a subscriber, please subscribe. Once again, Groundhog Day with Case-Shiller every month. What can you say? It's getting tiresome, and it's almost like I'm over it. I'm bored. Let's get some more fun in the real estate business here. All right, guys, reach out to me. Look forward to speaking with you later in this week. Everybody take care.